Now by Scott Haslem from Sydney. He's chief economist for Australasia at UBS Securities. Scott, good morning. Thanks for joining us.
Hi there.
Scott, so no change in rates today. That seems to be the consensus. But is a change in rhetoric warranted?
Well, I think it's unlikely that the RBA won't at least acknowledge a moderate pickup in core inflation in the first quarter. They may even mention the unemployment rate dropping below 5%. So given the very neutral statement that they made this time a month ago, it seems likely that today's statement's going to have a little bit more of a hawkish tone to it.
What does that mean for the future direction of interest rates, Scott? When do you expect the next hike?
Well, I'm not looking today for the RBA to signal imminently that they're going to lift interest rates. I do expect them to make the opportunity for them to lift interest rates over the next few months more likely. We think they'll wait until August to give the economy a little bit of chance to show some growth in terms of the consumer and housing sectors, which are pretty patchy at the moment. So we've got the next move in August. We think they'll start signalling that today, and the case will build over the next few months as the economy starts to look just a little bit better.
Still, bank loans to households and businesses grew the most in 2 years. So, you know, that's a worrying sign. Why not just dampen those concerns and concerns of second price risks and raise rates now?
Well, I think there's some question marks over just how much inflationary impulse there was in the first quarter. There does seem to be some seasonality in the Australian underlying inflation data that does tend to give the March quarter a little bit of an additional kick. The RBA is still mandated to target consumer price inflation, not commodity price inflation, and the consumer and housing sectors are pretty patchy. The credit data, given a history of very fast growth in Australia, still is quite moderate by our standards and is tracking below income. Savings is high. The consumer is still quite cautious. Housing prices are falling. There has to be some wariness about lifting interest rates too fast, too early. Australia remains the only country across the advanced and developed world which has interest rates in a slightly restrictive position. Inflation's sort of middle of the band. I'm not sure the case is that pressing that we'd need to see it today or tomorrow. And in fact, I'd expect to see the RBA only responding to some improvement in the economic data over the next few months.
And of course, the strong currency as well, Scott, is containing inflation as well. Where do you see the Aussie dollar? I mean, we're at record highs. Surely it's hurting manufacturers who sell goods abroad. What's the outlook for the Aussie dollar?
Well, again, I think that's interesting that Australia probably has one of the only purchasing manager indexes, PMIs, in the world, which is below 50, reflecting our manufacturing sector clearly is having a tough time, along with other sectors like education and tourism in Australia. In terms of the currency, we've got a view that it's likely to drift lower when the US Fed signals that it's likely to lift interest rates. I'm not sure the end of quantitative easing is enough to see the Australian dollar come down, but if we look at the history of 2004, when the Fed did start lifting interest rates, it did send the Aussie down about 10%, and it did go nowhere for a couple of years. So I think the Aussie will drift down over time, but in the meantime, while the Fed is still at near zero on interest rates, I think the Australian dollar will remain well supported and around current levels.
Scott, thanks. Scott Haslem there from UBS Securities.